None of this phony baloney, unallocated, bank certificate crapola. None of this ETF. Oh, I own gold, Andy. I own the GLD. No, you don't. You don't own Jack.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, this community keeps growing more and more every single week, and we thank you for that. Now, there's a lot to talk about during these historic times, and Andrew Maguire is in the house with an industry expert, and of course, by popular demand and one of our favorites from the Vault community, Mr. Craig Hemke is in the house, and we'll be talking gold today. So fasten your seatbelts. It's going to be an amazing episode, and you're not going to want to miss a word of what's coming up here. And, Live from the Vault gives you access to information and updates that you just can't get anywhere else. And this episode is going to be no exception. And just before we go to Talking Gold with Andrew Maguire and our special guest, Craig Hemke, please help us spread the word about this channel by hitting that like button, sharing this information with people that you know, and also hit the subscribe button. Now, if you hit the bell right there, you see that little bell, you'll be notified in real time as each episode goes live. And so with that, let me give you a little introduction for those that don't already know Craig, our special guest. Now, Craig began his career in the financial services back in 1990, but he retired in 2008 to focus on his family and entrepreneurial opportunities that came about. And since 2010, he's been the editor and publisher of the TF Metals Report, and he can be found at tfmetalsreport.com, an online community for the precious metals investor. And with that, let's head over to the UK and Talking Gold with the one and only Andrew Maguire and our special guest, Craig Hemke. Over to you, Andy.
Hey, Craig. It's so good to have you on board again, my friend. Goodness me. How long is it since we've actually done one of these? Well, I know we haven't seen each other lately, but I do pop on your site on a regular basis, and it is a real good experience. And I do honestly suggest people will see you there and hear you there, and they should do that.
Well, it's nice to see you, Andy. Yeah, I don't know. One of the thrills of doing this over the last 12 years is all the people I've met around the globe that I never would have met otherwise. In fact, I was just thinking about this last night. I was out. Anyway, it doesn't matter what I was doing, but I was thinking about how weird it is. I still am amazed by the people I've met, the billionaires, the people that are way smarter than me that I never would have had a chance to meet if I hadn't stumbled into this deal 12 years ago. And you're right there at the top of the list. I remember when I first started getting into the precious metals in 2009 and 2010, there was this guy named Andrew Maguire who's like this mythical figure. And now, after all these years later, to call you a friend, it's still just remarkable. So anyway, so it's great. Hey, did we ever get to 1 million views on our little video you guys made of me that one time?
Actually, I'll have to check on that. I reckon we must have got pretty darn close to it, if not more.
That was still an all-time classic.
And we should put that up again because, to be honest, it says it all. I mean, it really encapsulates it into, and the boys did a lovely job of that.
Oh yeah, and sadly, what was it? Maybe that was 2 years ago, and every point is still valid. Unfortunately,
every single one.
Unallocated metal and the kind of the shell game that gets played, but whatever. It was you guys did a great job.
Well, and I think we've had this is an interesting year. So, and I know that you've done a lot about 2022, 2023. Been some big changes. We're both looking at the same picture. Maybe I'm looking at it more on an Eastern basis. You're looking at it at a big global picture too. But really like to get a sense of your side of the pond. Right now, you're living there. You are experiencing really what? Tell me what you're experiencing regarding. The Fed. I mean, my goodness me, I did something with Bill Halter last week. super guy, lovely guy. And he was talking about 1913, and he was talking about the final chapter is here, that very final chapter. And he said, it's a playbook. You're living there. Tell us what's happening.
Well, yeah, I've always appreciated your focus. You've taught me so much about the global and the wholesale market and how that operates, and how important that is. But sadly, as our friend Ned Naylor Leyland coined that phrase 10, 12 years ago about the future's tail wagging the spot dog, sadly, that continues to this day. And you can even see it on holidays like, the U.S. has celebrated President's Day not too long ago. So it's a Monday holiday where the U.S. markets are closed, but none of the other global markets are closed. And on that day, just like every other time when it's a U.S. market holiday, and the metals prices really don't even move. They might go up $5, then give that right back. Again, which is just kind of more anecdotal evidence that it's that futures trading in New York that just is such a huge driver of price. And obviously you and I could go on and on and on and on and on and on about what a scam and a fraud all of that is. But it's still accepted as a form of price discovery. So it is what it is. Okay, so then if that's the case, then we have to get to the bottom of what is going to drive demand for those futures contracts. And currently there's none. Andy, I'm sure you watch this daily too. I'm astonished by the levels of open interest on the COMEX. Gold, as we speak, is around 420,000 contracts. That's it. Those are 9-year lows for the total amount of contract open interest on COMEX. And about half of what the all-time high was almost exactly 3 years ago in February 2020. The all-time high was 800,000. And so now we sit here at 422,000, the same as in silver. Silver got to 246,000 contracts or something at about the same time. And now it's 124. So there's no demand. There's no interest in owning gold at any level. Everybody just thinks, whatever they think. So we need to get, if you're going to get price to move, if price is determined by the futures contracts, we need to get the parties, the machines, whatever, the hedge funds, the institutions that buy those futures contracts. We need to get them excited again. And I think this year is going to play out much like previous years that we've had, 2010 and 2019, where everybody entered the year thinking the Fed was all hawkish, the Fed was going to be hiking rates, the Fed was going to be prudent, the Fed was going to be drawing down their balance sheet. And then at the first sign of economic weakness, they flip as quick as they can. Here comes the rate cuts, here comes more QE. And in the back half of 2010 and in the back half of 2019, metals took off. And then in the following years, 11 and 20, is when they really made some hay. And I think that's probably the most analogous set of circumstances of where we are. And again, we need the economic and mental conditions, I guess, for people to understand, again, there's no getting out of this. The Fed is always just going to keep the plate spinning as long as they can. So therefore, hey, let's get back into gold. And we are definitely at a trough in terms of interest in gold in all its forms at this point.
Yeah, and I think you've encapsulated it perfectly. The trouble is the average commodity trading advisor hasn't even had a mandate to take physical delivery, and so he's never going to do it. So knowing that, then and and financing his positions or their positions, then the pain point. So you can actually do egregious things against them because, well, they're simply not in their mandate to ever take delivery. So we'll push it. And sometimes we get these massive overshoots as a result of simply that. And I think, so really, as you say, if they got sticky and had enough margin, great. But I think it's the physical market now that is beginning to cause what you've just described, open interest starting to evaporate. It's not the same game. And as you say, it's interesting to see what you're thinking about 2023. But it's certainly, the game is shifting a little bit, because what happened was when we saw Obviously, it was a PSYOPs operation in March last year. We saw the Fed coming in with a PSYOPs operation. Let's get some sanctions on Russia. Oh, they're using gold, starting to use gold and this is the first sign of them using gold. And so what do? They come in and put a wall of paper supply. Then what happened? Suddenly by November, they hit a wall. And what happened was, during that time, we saw the first time in 50 years, central banks buying gold, more gold than they have since Nixon closed the gold window 50 years ago. So to me, that's kind of like a benchmark pivot point.
Yeah, and I think there's definitely validity to that, Andy, because if there is any, validity to the current pricing scheme, then there has to be something to all the central bank demand, the record couple of years in a row of central bank demand, keeping the price up. Because from the regular drivers of the COMEX price, if it's a nominal interest rates or whether it's real interest rates based off inflation expectations, you would have thought gold price would have fallen considerably farther than it has. You would think, it'd be back down to 13 or 1400, but it's not. And so, some might ascribe that to, everybody's looking ahead to what the Fed's going to do, but it might also be, what you're saying, this impact finally of the physical marketplace and frankly, the banks not being able to allow the price to go down. I'll give you one more along those lines. You're making me think of last fall when silver was banging around. And it had dropped through 22 and 21 and was down there around 18. And I kept doing interviews and stuff. People say, so silver's going to go to 14. Silver's going to 12. And I kept telling people, I said, look, this isn't complicated. If you recognize that in a bull market, the COT report gets heavy and the speculators get heavily long and the banks get heavily short. And then what happens? They pull the rug out from under and down it goes real quick, right? And it's just your spec wash and rinse cycle. We all know that's what happens, right? Yeah. Uh-huh. Okay. Well, last fall, there were 3 or 4 occasions when the exact opposite occurred, where the specs were heavily short and the banks were very long. And I kept telling people, why would you now expect price to go lower? If the banks always win in these games, then the banks are the ones that are long. The price isn't going down. And what the hell happened? 4 straight times we had these massive short squeezes. The fourth one finally shooting price from 18 to 24 and change. So I think there's something to that, Andy, that there's a level beyond which, the banks are unwilling to let price fall because they're the ones that are ultimately on the hook for the physical metal and they know what the physical situation is. And I'll give you one more, Andy, that I don't know how much this pertains directly to gold. But one of the key things I wrote about in my forecast, I write this forecast. I usually publish it the first couple of days of January. And it's a free article. Anybody can go to my website. I think it's called One Step Beyond. So if you want to go to Google, just type in, TF Metals One Step Beyond and you'll find it. Anyway, one of the other key factors is these base metal supplies. Whether it's copper or zinc or nickel, lead. I mean, you go down the list and there I've seen charts, that just kind of go like this, the known base metal supplies, whether it's LME, Shanghai, New York, wherever combined, the total volume of metal is just dropping off the face of the planet. And so I'm watching copper really closely this year because copper's LME supply is dwindling sharply. I'm sure you saw that story about Trafigura, I think that's how you pronounce it, withdrawing a bunch of metal from the LME and a bunch of copper from the LME because they want to make sure they had copper to deliver in the months ahead against their own obligations. What if, it's not so much gold that has this supply shortage that causes a disconnect. Maybe it's not silver, but maybe it's copper. Maybe it's nickel that causes traders around the world to go, as we've always said, wait a second, hold on just a minute. What kind of games are you playing here? And then that finally starts this run on all the other markets. So there are a lot of very interesting physical things happening this year. And it's, I think you're right. That's having an impact on price. Let's hope it continues.
Yeah, and I think you're talking about, of course, not silver not being Basel III compliant. There is no requirement for a liquidity provider to have physical. Whereas by the end of 2022, we had the BIS squaring all their positions to zero, 500 odd tons to zero, and positioning net long. And because the liquidity providers at this point you have to have the physical. So yeah, you can play a game to the degree that if somebody wheels around and demands it, you better have it. And so there is a degree of, obviously some leverage involved as well, because this is where the COMEX comes in, because you can then take a few speculative bets on the over-the-counter market, thinking, I won't need to deliver this because, by the way, I'm a market maker on both sides, and I'll just suck in some of these guys we just talked about, who I know I can rinse. So you do get that still, but it's not the same as silver, where you can just 500 to 1. It doesn't matter. They will just keep hammering that sucker. But we just mentioned BIS. What we do know now, and I've just done something on this today, is we now know through a very well-connected liquidity provider that it was the Fed that borrowed 100 tons of metal from the BIS in January. 100 tons of metal, because it backfired last time with the wall of paper. So they tried something else this time. Let's take physical metal. Okay, they've knocked it down by $100, and they sold it short probably around about 1,920 or something like that. So, but that's all the traction they got. Now, these CTAs are talking about, they're tapped out. There's nothing left to rinse. All you've got now is the momentum, the naked short momentum guys who are wrong at both ends and right in the middle. But so I think we're reaching a point where that's got to get repaid, Craig. It's got to get repaid.
Yeah. It reminds me of the end of the London gold pool. Doesn't it remind you of that? I mean, we're at the end. They're just taking all these desperate measures to keep their scheme in place. It's like, like the meme you've seen of the guy squeegeeing the tide back into the ocean, right? I mean, there's at some point it just becomes, you're just overwhelmed. So that's very interesting news you have there. Andy, as we look into this year, it'll be very curious to see what happens with price as we finally get to this point. Not on top of all this physical stuff, as the physical stuff limits what the banks can do to contain it on the short side, and whether they're willing to. Because again, with that open interest as low as it is, I mean, there's room for a couple 100,000 COMEX contracts to come in on the long side. I mean, that wouldn't be unusual. So, who's going to be the seller? Who's going to provide the other side of that, right? And even if the banks willingly do it, that's going to be quite a bit of upward momentum to the upside. And then you break out above 2,000, and then then all of a sudden that gets the headlines, and it garners even more full speed ahead. So we've got such an interesting year ahead of us, and I think the biggest challenge, though, for you and me and everybody listening, is to kind of not get really, really short-term focused, because it's still the same game. They're still going to try to wrong foot you. They're still going to try to wash you out. If, by God, we're actually getting commitment of traders reports, Andy. If we were, I'm sure the last month would show a massive spec washout in COMEX gold, right? And the same in silver. Just because of the price action, the open interest action. I mean, we can pretty well guess what the reports would be showing right now. But that's going to happen. It didn't just happen in January. I'm sure it'll happen a couple more times, because that's exactly what happened in, like I said, these other years that are analogous to this year. And again, this was kind of a focus of my report. I'll just kind of give a little more basis if people haven't heard me talk about that yet this year. As 2010 began, Do you remember, Andy? Do you remember coming out of the financial crisis? Everybody was talking about the green shoots.
Yeah.
Remember that?
Yeah.
Oh, the green, and that was supposedly, the economy growing back to life from the rubble of the great financial crisis. The green shoots were everywhere. Is not soft landing the green shoots of 2023, right? You hear it all the time. So you go back to 2010, that's all anybody was saying. Fed, QE1 was a one-time deal just to save the banks, was never going to happen again. Green shoots everywhere. And by the second and then into the third quarter, the economy was clearly slowing again in like a double dip recession. And what happened? By November 2010, here comes QE2. Back half of 2010, silver goes from 18 to 30 and then to 50. Gold went from 700 to 1900. Okay. That was because the Fed had to make a choice. Okay, now that we're playing this game, we got to keep it going as long as we can. Okay, fast forward. 2018. We enter the year 2019. Same thing. Quantitative tightening, Operation Twist, drawing down the balance sheet, normalizing interest rates, all the same rhetorical games they're playing now, right? As soon as the economy started to slow in the first and second quarter, we got rate cuts in June of 2019. There were no more rate hikes. We got rate cuts as soon as June. Gold and silver, boom. And then you get COVID, 2020, bang, right? So here we are again. 2023 begins. Everybody's talking about, well, one more rate hike, two more rate hikes. Well, who knows, maybe even three. I don't even care. Who knows how many it's going to be. The Fed is ultimately going to be cutting again and starting the machines again. And when they do, it's just so everybody wakes up again and realizes, that it's just the same old nonsense, that they can't stop and the balance sheet's going to expand and everybody will want gold again and gold futures and gold ETFs and all that stuff. I'll give you one more thing, Andy, that I think is little noticed, and again, maybe this time is different. I don't think so. I think if the past is prologue, then I saw a study a couple weeks ago that said over the past, whatever it is, 8 or 9 rate hike cycles, the average amount of time between the last rate hike and the first rate cut is 75 days. And you can actually see this priced into the current Fed funds futures market, where they've got a couple more hikes into June and then a cut in September and a cut in December. Okay, so it doesn't matter if they hike again in March, maybe one, who knows. They're in the process of driving the economy in the ditch. That will become apparent in the first 6 months, 8 months of the year, whatever, just like it did in 2010 and 2019. And then by autumn, it'll be all the rage again about how much the Fed has to cut. Are they going to cut 50 basis points this meeting because the economy is so bad? The job report was negative last month, all that kind of stuff. And that's when gold will just be soaring again. And I don't mean to make it sound like it's so simple that a dope with a MacBook could figure this out, but all we have to go by really is history. And outside of some, extra circumstances, geopolitical or whatever, that make this time different, I just don't see how this plays out any differently than it has in the past.
No, I get what you're saying. And I think what's interesting is when we look for, obviously we all wished for a different situation. We wish for the end of the paper market. But what was so interesting, I think, on the first trading day of 2023, Russian Sberbank came out and literally launched, obviously an official Russian platform, to digitize physical gold, put it on the blockchain. And this is the first step of commoditizing or allowing gold to be literally on the blockchain, to be used as a currency to buy and sell commodities amongst the 3.8 billion SCO members. Now, okay, so we've got a bit of a dynamic there. That's never been there before. This is physical gold literally being shoved into that blockchain as a currency, and they're taking this gold out of the one supply, global supply. And there's only one global supply, and that is, we all know what the rough amounts are. We certainly don't know how much smuggling goes on in India. I mean, we have estimates of it, but essentially, when you start removing physical gold, which underpins the paper market leverage, then that's maybe one of the reasons why you're seeing this contraction in open interest, because hang on a minute, it's getting, especially in gold, it's NSFR compliant. So hang on a minute, we're not stupid. We're not stupid. Yes, we want to rig the market, but we're not stupid because shit, if this thing blows back and somebody turns around. And I think, so last time they capped it in the 1950s or whatever, 1940, whatever it is. But I'm thinking there, at this point here, now we get an adoption of physical gold onto the blockchain in Russia, China. They're looking to create this currency, and it is happening. And this physical gold. And okay, obviously everyone's been sitting back and saying, hey, we've got momentum down. Let's sit back. Why go to a producer? Why buy anything when the price is coming to us? But then, as it's always the case, everyone gets in on the way up and everyone gets out on the way down. And then we reach a point where, as you've just described, where it just has to snap. So what I'm thinking is that the next time we rise, and you were talking about, hey you guys, CTAs, there comes a point where if you do add 200,000 contracts long and you are rinsable, maybe you're not rinsable if underpinning your position is physical buying going on in the rest of the globe, underpinning your position as you step higher. That could be the thing that blows these guys out of the water.
Right. That's exactly right. And I remember talking with you last year, about the Basel III stuff. What if the traditional market makers, the banks that provide the short end of the contract on that open interest, what if they don't want to play? What if they want to play at only half of what they've played before? You don't get that same dilution of the total contract open interest suppressing price. And then it kind of can catch a life of its own. I mean, we really, again, these are things that you and I can anticipate and can plainly see happening. It's really only a question of timing, right? It's like the whole de-dollarization stuff, like you said. I don't think there's any question, especially as things have been sped up last year in terms of these, we'll call them adversarial countries to the U.S. beginning to work together to create their own system, because obviously the U.S. showed you get sideways with the U.S., we're going to kick you right out. That's coming. You just don't know how fast that's being implemented, right? And so in the end, it just augurs for everybody that is a part of the Kinesis system, everybody that, is just a regular stacker buying, taking some of their savings every month and buying an ounce of gold or a fractional ounce of gold. It's just a critical diversification for what is most definitely coming to be kind of a lifeboat in this storm that is washing ashore. The physical market, like you said, underpins all of these crazy paper games, and we've waited for these paper markets, to kind of implode on themselves, and there have been signs of it. The gold market really was on its knees in March of 2020. We've seen what happened in palladium the year before that. We saw what happened in nickel. Was that last year? Okay, so there are all these fractures happening in this digital derivative and fractional reserve pricing scheme that are kind of waking people up. And they've been able to kind of paper them over, no pun intended. But that whole, that awareness that's out there will only help speed the process once things really start going in our direction. I don't know. This is going to be a very pivotal year to see what happens. Not only, will the Fed just simply shift like they have in the past, but what will that do to price? How much then does price rally? And then, Andy, these CTAs that you're talking about and the other hedge funds and the other institutions that get washed back out, the people that buy the mining shares, write them up, and then say, now the Fed's going to play the games, and then they just dump them right back out. One of these times, they're not going to dump them back out. People are going to wake up and go, wait a minute, hold on a second. I'm not falling for this again. Okay. At $1 trillion, they said it was going to, then at $2 trillion, it was going back to one. Then at $4 trillion, it was going back to one. Then at $9 trillion, it was going back to four. Now we're at 14 trillion. I'm not buying this anymore. I understand what the end game is, and we finally get into one of these cycles where things just keep going up, like 78 and 79, where gold goes to 200 back to 100, then to 900. That's what I'm really curious to see if that's finally what we're on the verge of. That all notwithstanding, the implode, if finally the legs get kicked out from under the system just by pure physical demand, that you've been discussing all these years too.
Yeah, and when you think that the current game, it became pretty obvious that the current game, we often think, well, what is the main, obviously it's the HFTs, it's the algorithms that are automated and they're set and they're programmed, they're directional. And so what was really interesting was that this very recent, the most recent gold raid. And what happened was that, and just to illustrate, I mean, we're trying to tell people, really here's a perfect illustration, is that, so the gold price, so the dollar was falling down at the beginning of the year, and then it rose back above the 50-day moving average. And what happened was, funnily enough, it rose back to the exact level that gold started rising on the 5th of January. So this was a full gap close. In other words, but it's just it just shows the correlation. It's really paper to paper. And so suddenly you see, hang on a minute. So the gold price goes back to roughly 1829 or to 1828, which was the exact level that it rose when central bank buying came in after Russia launched this gold digital currency. And then we saw this rise. And then the dollar index falls. But the two married exactly together. Exactly on exactly that same point. So it kind of illustrates, but what it doesn't account for is, aside from all of this bullshit, there's a physical market, an actual physical market, but no one sees it other than the guys who are enjoying it. And thank goodness. I mean, look, Craig, you provide so much good advice. What do you tell your people to do? Certainly, go and put all your money in the bank. Why don't you loan all their money to the bank? What are you telling them to do? Are you telling them to opt out?
Well, I think it kind of starts with what you were talking about, the central banks. I use this analogy a lot. I mean, look, you and I both hold central bankers in rather low regard, but they are educated people, right? They all at least have some idea of what they're talking about. And what are these global central banks doing? Again, we're not talking the Fed or the Bank of England. We're talking about all these other creditor nations that have dollar reserves that are taking their dollar reserves and moving some of it to gold for various reasons, right? So where'd they get these dollar reserves? They got these dollar reserves through trade, through foreign trade, right? Doing business. They get paid in dollars. They end up with dollars. And they can either save in dollars and own things like treasuries, or they can diversify out of dollars into gold, right? How is that any different from what you and I do, Andy? I mean, you get paid for all your work in pounds. I get paid in dollars. You can either continue to save in dollars and pounds, and buy gilts and bonds and stocks and whatever, or you can take some of your dollar reserves that you've accumulated and buy gold. It's the same thing that they're doing. I don't think it's something that we'd never recommend anybody just take everything and just cash out of the system, because you don't know, you can't say for any certainty when all these changes are going to happen. Hell, I didn't think we'd make it out of 2011. And here we are, 2023. So you've got to, there's opportunity costs that comes with putting all your eggs in one basket and that sort of thing. So you never want to do that. But there's definitely value in understanding your monetary history. The fact that, that you start with a monetary system that's backed with something, a currency that's backed with something, usually gold, so that people have confidence in using it. And then over time, as demands for that currency grow, they just start kind of lessening the value of it and cheapening of it. They're like the Romans shaving off their coins and stuff, to the point where the currency becomes backed by nothing, and everybody loses confidence in it. Like the wheelbarrows of Reichsmarks, right? Or Deutschmarks, whatever they were. Anyway, the point is, then what do you got to do? You got to back it with something again. The pendulum swings all the way back over to reinstall confidence. All right, so if these BRIC nations, some combination, Russia, China, whatever, if they want to offer some kind of alternative to give them something that they can use outside the U.S. system so that when they anger the U.S., they don't, get kicked out and penalized, well, they're going to have to back it with something to get other parties to use it. So who knows? I just think the most logical thing they back it with is gold. And if that's the case, then you definitely want to own some gold, because that's going to break apart, this current Western-based, New York, London system. And it gets, in the end, Andy, it gets back to the topic you and I have discussed for years. What is the actual price? What should it be? Because $1,800 an ounce is this phony baloney price based off of all this phony baloney gold that trades. If you just boiled it down to a physical ounce for $1 or €1 or whatever, and that's all we were basing it off of, what would that price be? And again, I just know it's not 1,800. I don't know what the actual price is. I don't even know how many ounces there are, right? I mean, we have no idea how many unencumbered, unleveraged, unrehypothecated? Is that a new word?
Yeah, it's his word.
Thanks. Put that in the Urban Dictionary. Anyway, we're going to get to the point where we figure out what that price is, hopefully in our lifetimes. And it's not going to be $1,845, I can tell you that. And so that's all part of what we talk about on my site. It's not like I can give advice, but I try to give people, I think, a learned, wise, and make it sound like I'm some old sage like you, and try to tell them what I've learned all these years and try to apply it, for present day to keep them involved and I've had a lot of people thank me over the last 4 or 5 years for keeping them involved through 2015 and 2016. And again, the only reason I did is because the math is the math. I mean, it's not like we're making up the math. It just is what it is. And so that's a big part of what we do too, is just making you hang in there and stay patient. And that ultimately for this year, that's also very important. I hate using the word patient because every time I do, and there will be people in the comments of the YouTube stream that this channel, that this video is on, that say, I've been patient for 12 years and I'm tired of being patient. So I hate using that word. But this is a year you got to be patient. Just this year, okay? Don't let them wrong. If you sell, think of who's buying, right? Right? Somebody's buying your position from you if you get impatient and sell this year. And they're going to try to wrong, because the banks know it's coming. Okay, they know how this is going to play out. They're going to try to wrong foot you. They're going to try to throw you off. They're going to try to take your position from you, and you can't let them do it at this important time. And that's, again, it's a very long answer to your simple question, Andy. It must be this coffee I've been drinking the whole time.
No, I think you're right. It's about education, and I think that's all we can do is present different views of different things from different perspectives. But I think I often say to people, look, okay, I had a guy just sold his business. He said, what do I do with all my cash? It's in pounds in the bank, which could be any currency. It doesn't matter. So I said, well, okay, just think of it as, think of all your asset classes, whatever they are. I don't even need to know what they are, but your various asset classes. One of them is cash. Hang on, you're going to lose 10% this year in investing that in the bank. Now, the bail-ins aside, I'm not scaring you with the bailing potentials, because if one of those banks goes down because the derivative market collapses, you could lose all your money. But essentially, it's an asset class. So bearing in mind that anything, if I touch this cup, it will cost, it doesn't mean the cup is costing more. No, the cup has always been the same price. It's just cost more pounds or dollars to buy the same cup. Same with your house. Oh, I made 20% on my house in this. No, you didn't. The house is the house. It costs 20% more dollars to buy your house. So, and I think, we look back to 1913 and a barrel of oil cost 22 ounces of gold. Now, 110 years later, it costs 24 ounces of gold. Yet the price is what? So, it goes to show you. It's about any real tangible thing. Your table you're touching, it's actually going to cost more dollars next year, the year after. So I just say to people, be careful where you place your money. And if you think that you're happy to lose 10% a year, or probably more actually, and you go to the supermarket, is it 10%? I'd say it's more like 20%. But, what do you think?
Well, I think a lot of folks have seen those charts, especially since 1971, when Nixon closed the gold window. The income disparities, specifically in the U.S., the net worth and wealth disparity in the U.S. has just widened and widened and widened just because of that. If you've got assets and you can keep up with inflation and that devaluation, then you're feeling or seeming to be doing okay. It's those that don't. And here in the U.S., 2/3 of the population doesn't even have $1,000 in the bank. They're the ones that are, just endlessly being squeezed by all of this. And Andy, one of the things that, and I just wanted to ask you this, because I don't, before we wrap up or anything like that, I just wanted to make sure I asked you. When the last time I spoke with you, you had talked about this notion of the BRIC countries starting to price commodities in gold. I don't know how much more you've heard about that. I had spoken a couple days before. You may remember me telling you this. I'd spoken with Ronnie Sturfula, the In Gold. Have you ever had Ronnie on here?
No, I haven't, but I should do.
You should. Well, especially that In Gold Trust comes out in May, so he'll get pretty busy beginning next month. I don't know if he's such a smart guy. Anyway, I was talking to Ronnie, and one day, and he said. He was reminding me of U.S. Treasury Secretary Connolly in the 60s or the early 70s, famous for saying the dollar is our currency, but it's your problem, right? And how the mantra going forward now is going to be, they are our commodities and they are your problem from all these producing countries. And it was, I think the next day I spoke with you and you said, yeah, I've been hearing about this notion of these commodity producing countries pricing them in grams of gold. Have you heard? I just would love to have you tell me more about that. And I bet everybody listening would benefit from that too. Are you still hearing that as a trend?
Oh, 100%. And in fact, this is what Sparebank did on the 3rd of January. It literally blindsided the market by saying, we're now digitizing physical gold, putting it on the trustless blockchain. And what they did, that actually is placing a gram price of gold to be exchanged for commodities. And let's face it, 2/3 of the world, 3.8 billion people, two-thirds of the world, we're like 1.8 billion, are literally the main producers, consumers of commodities. No one trusts the dollar. So it's been weaponized, and they all recognize that. Russia, China, all the BRICS countries want to de-dollarize. You can't do it overnight because you shoot yourself in the foot. But by digitizing it, by using these overvalued dollars to buy physical grams, which are completely discounted, what you're doing is essentially creating a currency. And obviously, the more that happens, probably the higher the price will be. But when you think of liquidity, and we're talking about liquidity, when you look at the oil, the gas market, the commodity markets, we're talking 12,000 billion in size. There's potential liquidity. And then people say, well, there's no way, gold is not liquid enough. Oh yeah, it is at the right price. At the right price. And I think that's what we're seeing. And we're seeing this change in behavior. We've never seen a competing central bank openly say, we're now taking physical gold and we're going to gram price all commodities in grams. What that's going to do for silver? When you price silver in gold grams, not dollars, what price is silver? I have no idea, Craig.
It's not a a gold silver ratio of 85 or anything like that. I would imagine it'll drop that ratio down some.
To God's given ratio, which I think Bill Halter says is 12 to 1.
Something like that. No, again, this is the longer term proposition. As you learn more about the metals in the monetary system, and then learn more about the history of the pricing scheme, you begin to realize how the price has been managed to this level. You mentioned earlier about gold versus crude oil. I'd say the only reason that they almost still kind of match up is because they price crude oil the same way. And the crude oil producers can't be happy about that either. And so all of this kind of epochal change is happening, as we enter 2023. And those changes usually happen gradually, and they've been happening gradually since really the great financial crisis. That kind of woke up all these parties to, that the dollar end game was kind of gradually upon us. But the COVID thing and the free money and the trillions of dollars of new cash, combined with what happened last year at the onset of the Ukraine war, where, the biggest weekend of the year, the biggest news really of the year was that first weekend of March, when the U.S. kicked Russia out of SWIFT and seized all their foreign held currency reserves. That was the biggest weekend of the year. And that took that epochal change and kind of gave it a shove forward. And that's why, again, there's been money to be made playing the fiat game over the last 10 years. And if you've been anybody like me that's been invested in gold and the mining shares and stuff like that, have had an opportunity cost we've had to pay, where we could have just been owning Tesla and Apple and, and making all these fiat dollars. But I don't know if that opportunity cost is going to be the same going forward. I think now that change is being sped forward, it really means that people, if you've not already currently holding some physical metal, either in your hands or at Kinesis or, some vault in some place, whatever. If you don't currently have some physical metal, if you've been waiting for the time to get involved, just look around you, read the headlines, educate yourself, and I think you'll decide, maybe this is a time I should start kind of, buying. Again, what a great platform Kinesis is. Just go on there and buy $500 a month. You just take $500 a month and just, whether price is up or down, just start buying some. It's a great platform for doing that. And again, diversify out of dollars into some physical metal because you know the direction this is headed, because that's the way it's always headed in the past. And again, you can certainly read that, if you're paying attention, you can certainly see it coming again.
Yeah, I think, Craig, you've nailed it. I mean, when you opt out of a system, which is essentially what we're saying, we're opting out of this Fed-driven system, this whole central bank system, you need to opt in to something else. And you can't just sort of sit in limbo, I'll just be happy with the bank handling my money. Well, maybe I'll get bailed in, maybe I won't, maybe I'll risk it. These are risk choices. And of course, so I think that's what I think is encouraging for what we're doing at the moment, is the ability to opt into something that is viable, that is growing. But I think one of the things I think people continuously question, but when the gold price, I mean, obviously we just described why the gold price. So we've got all these things going on, including probably we should be seeing a higher gold price. So based upon purely supply demand, with now 2/3 of the world starting to price commodities in gold grams, the price from a supply demand basis is going to rise. It has to, because you're now taking more supply from a finite supply. So what's that going to do to inflation around in the Western world, who relies on dollars, pounds, euros to buy the same commodities that they need, and they're being priced in a gold at a higher price? That's massive inflationary input.
Right. And again, on an even more base level, if everything is priced in dollars as it is now, and if the value of the dollar is falling, then that makes all those commodities go up as well. I mean, this gets to that discussion we were having earlier about the alternative being offered. Anything that siphons away demand for dollars, which is what that does, any kind of BRICS trading currency, gold backed, whatever, strikes the petrodollar, that sort of thing. Anything that siphons away demand for dollars lessens the value. It's like any old, supply demand curve. If you took an economics class in college, we could be talking about oranges or lawnmowers or, anything, any good you have where supply meets demand is where you find price. And what we're talking about here in terms of dollars in the bigger picture, if demand for dollars is falling because these alternatives being created, at the same time, supply of dollars is increasing due to all this, the ever-increasing amount of debt, and the dollars need to service the debt and to keep the plate spinning. You've got falling demand and increasing supply. The market resets that value lower. It's like I said, anything. Like go to your hardware store. If all of a sudden there are way more hammers than there is demand of the demand of hammers, they're going to mark the price of hammers down because they got to get rid of it. That's just economics 101. So as the value of that dollar falls in the years ahead, just because that simple supply demand curve, then that impacts everything as well. At the end of the day, Andy, what we're talking about is all these different semantical ways of trying to explain to people that gold's not going to stay at $1,800, and silver at $2,150 or whatever it is not going to be the price going forward for time immemorial. Now, again, people in the comments are going to say, yeah, well, silver was $48 in 2011, right? That, is half of what, fine, okay, right, sure, no doubt about it. But it was also 14 in 2015, so it's up from there. All of these things combined mean that going forward, prices are not going to remain at these levels. How far they go up, and how fast they go up, I have no idea. But for people that need to diversify, need to be starting to build positions out of dollars into something else, this is the time to be doing it on whichever platform, whichever form, however you want to do it. Just make sure you own physical metal. None of this phony baloney, unallocated, bank certificate crapola. None of this ETF. Oh, I own gold, Andy. I own the GLD. No, you don't. You don't own jack. Own physical metal, gold and silver. Have it either in your hands or at a trusted place where that you trust, and then you're prepared. Then you're prepared for all these things that we've been talking about.
Yeah, and so what you're saying essentially is, guys, it's going to cost you a hell of a lot more dollars to buy the same ounce of gold, the same ounce of silver as we go forward, as it will all other commodities as well. But again, gold has that extra push here where we've got already last year we had the central banks buying more gold than Nixon closed the gold window 50 years ago. So we've already seen that, and they must have known what they were going to launch on the 3rd of January, which was digitizing physical gold, putting it on the Stellar blockchain. Hey, guess who does that? They must be copying Kinesis, I think.
Well, and what happened for biggest central bank demand since 1968? What happened in 1968? I'm trying to remember. What was 1960? Oh, that's right. That was the end of the London gold pool. Right?
Exactly. Things happen.
Here we are, central banks. Central banks are the ones involved in the London gold pool. They know what's going on, right? So if they're buying more gold now than they have in 50 some odd years, you might sit up and pay attention.
Yeah, that's brilliant. I think, Craig, that's a wonderful place to finish. As you just said, own physical, nothing but physical. Make sure it's safe. Make sure it's somewhere stored very safe. It's a question is, how much do you own at this point? Exactly.
And as you said, that's all you and I can do. That's what I do every day at my site. I try to keep people focused because the news comes at you so fast, and that's much of it. Think about all the COVID stuff. and the political stuff and the war stuff. Much of it is the news is managed to really almost misinform you into thinking a certain thing. And so it's so important on a daily basis to be able to, to do what you do, to people I try to help, to keep them to kind of siphon through all that, and brush everything aside and actually see what's going on. Because like I said, the news is designed to keep you from seeing what's going on. And so in a year like this, I think I've concluded every interview I've done since the beginning of January with just begging people to get as many objective and as an independent source of information as they can. I mean, obviously that's what I do, that's what you do, but it's not just me. We know all kinds of people that have newsletters, YouTube channels, Substacks, all that kind of stuff. It is incumbent upon the individual this year to take the time to learn and educate yourself. Get as many objective and as experienced, wise voices that you can, and get the full picture. If you're this is not the time to be sitting there, just watching CNBC and swallowing what they tell you. You've got to take control of your financial situation for yourself this year, and it's just extremely important that you go out and find a group of people, as many sources as you can, to keep you up to date on a daily basis.
And by listening to the likes of yourself, the likes of what you've just been talking about, you can make a better informed choice. It isn't always going to be the right choice, but it's a better informed choice. And as you say, it's all about taking personal responsibility, not letting someone else do this for you. This is filtered through your own actions. If you get it wrong, you learn something. You get it right, then that's great. But I mean, really, essentially, it's about, you've just said it, Craig. You've said physical, take responsibility. I mean, these are benchmarks in my mind every single day. And you can leave the woke world behind because they won't hand their hand out. They put their hand out, but there'll be only less and less dollars to pay them in the future.
Right. Or you call your stockbroker, or you ask your next door neighbor. I mean, you call up your stockbroker and say, should I own some gold? They're going to say, do I make a commission on that? No, you shouldn't own any gold. That's how that's going to work. No, you've got to, again, it's just imperative upon everybody. In this is a very critical couple of years we're entering here. Part of being in a democracy and a republic and, in a free society is you've got to educate yourself. You can't just get steamrolled. And that's why everybody should be watching your From the Vault every week. That's where everybody should be finding websites they can trust, finding Substack writers they can trust, newsletters they can trust. And again, this is the time. You got to be educating yourself and thinking for yourself and planning for the future.
I would encourage people to go to your website, TF Metals. It has been a resource for many years. It's one of the longest standing information channels out there. And goodness me, Craig, I can't believe it. How many years has it been running now? I mean, I can't remember when it wasn't. You used to wear a hat, didn't you?
Yeah, back when I was anonymous. Back, in the old days. But I just can't believe it. Andy, geez Louise, we were young guys back then.
How many years ago was that?
2010.
Wow. That's amazing.
We'll be 13 this year. And,
so are you going to give people an anniversary price to come in and visit your store?
Yeah. Well, it's not much more than $12 a month. Maybe that's what I should do going forward, is charge per month for every year that we've been doing it. But
I honestly mean people should come and check you out. So obviously we'll put a link in.
Thank you. And you hit subscribe, you go to the subscribe page, and it's like any other site. You sign up for an account. It's $15 a month or $145 a year. And again, I take it or leave it. I've got enough people on my site, but I'll take it. I'd take as many as want to be there. This is just a time. And what I tell people, I'm kind of your eyes and ears. I'll write a report in the morning and telling you what's going on. And I'll record a podcast every afternoon, and update the charts and tell you what you missed. And therefore, you can kind of go about your life and do other things, and I'll keep you posted because I'm sitting here paying attention to this crap all day long. And if you think there's value in that for 50 cents a day, come join us. It's a pretty good, it's a vibrant community. There's probably 100 comments per thread, 50 comments per thread, of everybody else chiming in, putting in their own content, finding their own links that they have found, on all sorts of different subjects. It's a pretty cool place. It's just a gift from God that this is what I do for a living, and I'm honored to be the guy that runs it.
Well, I encourage everyone to click on the link, and thank you, Craig, yet again for sharing your valuable insights, time with us. You're a friend indeed. You're a friend of everybody, but you're a very close friend of mine too, and I really look forward to the next update we do.
Sounds good, Andy. Anytime you want. You got it, my friend.
Well, there you have it. Thank you so much, Andrew Maguire and Craig Hemke, for another fascinating discussion. Now, to all of our community, remember to buy physical, only buy physical, and make sure it's one-to-one. Understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. Now, please help spread the word about this channel by hitting that like button, sharing this information, and make sure you subscribe. If you want to be notified in real time as each episode goes live, just hit that little bell there and we'll do just that. And so with that, we'll see you next time right here on Live from the Vault. See you then.